How's it going? If you haven't seen the first iteration of this trading series, I recommend you check it out. It's going to be up in the corner here for you to watch. It'll give a lot of context to what we're doing, otherwise you might be a little bit lost in the sauce, although I'm sure you'll still have a good time. Today we're going to be getting into the wheel strategy, so if you're not familiar with that strategy and you want to learn it, or you just need a refresher, you can find a tutorial to it up in the corner, and you can find links to every single helpful video that would help you at all in the description below. What you'll also find in the description below is a link to the mobile app called Iris. It'll allow you to follow every single trade I do. You can get live notifications if you want. Also check out Pins by Charlie down there while you're at it. They sell some pretty dope pins. I recommend you give her a look. All right, with all that out of the way, let's go ahead and dive in and catch you up on a few things I did while you weren't looking. Here we are in our monitor tab. You can see our long-term positions and our leaps. A couple things. Number one, I deposited an extra $1,900. Okay, I'm going to be depositing money across time. But the good thing about today is we're going to talk about the wheel strategy where leaps last time might have been like, Jesus, that's really expensive. I can't afford that. The wheel strategy, most people can afford it, at least on margin, as long as you choose the right stock. Okay, so I'm going to be adding money to this portfolio, and I did. I added $1,900, and I bought some NVIDIA. I bought some Twitter. Okay, we added some more Microsoft and Apple. And if you follow me on Iris, you'll see all this. And we added a PayPal leap. This PayPal leaps is not really a leaps, actually, because if I go to the PayPal options chain and I close everything up, you can see my position for this PayPal leaps is on January 2022. Unfurl that, and you can see exactly what strike it is. Look at that. It's pretty close to at the money. The delta is a 0.67. It's not a 0.9 or 0.8. It's a 0.67. The reason for this being, I can't afford with this portfolio to throw $8,000, which would be the cost of around a 0.9 delta, $9,000, into this one position. I can't do that. But, you know, I almost walked away from opening a position at all because of this. But if you look at the chart for PayPal, two things. Number one, you can see that implied volatility is nice and low relative to its historical implied volatility. That's great because, well, obviously with any call option and expansion, implied volatility is going to be good for that call option. It's going to inflate the option's premium. You can make money through Vega instead of just Delta. But also, because this option is at the money, you can see that, or pretty close to at the money, you can see that it has a very high extrinsic value, about $2,300 given to the option based on extrinsic value, which is about half the value of the option entirely. The reason it has such a high extrinsic value, and the reason this is good, is because extrinsic value is made up of implied volatility and time working together, okay? Implied volatility and time determine whether or not an option is going to get in the money and how deep in the money it's going to get. Extrinsic value is highest without the money options because there's more emphasis given to at the money options based on implied volatility and time, because implied volatility and time are going to determine whether that at the money option ends up in the money or not. It's the two things that determine an at the money option's fate. So more weight is given to at the money options because of implied volatility and time working together, and you can't have one without the other. Time is useless if there's no volatility. Stock just trades sideways. Implied volatility is useless without time. It has no time to take effect. They have to be working together. So because there's more uncertainty with at the money options and those two things determine at the money option's fate, there's more weight given to at the money options based on those two things, and so therefore it has the highest extrinsic value of any strike because extrinsic value is composed of those two factors. And this is good for us because that means our Vega is highest. Look, at the money options have the highest Vega, 0.94. You get deeper in the money, it starts shrinking. You get further out of the money, it starts shrinking. At the money options have the highest Vega, so they're more sensitive to changes in implied volatility, which is good for us because if you look at implied volatility, like we just said, very, very low, could expand explosively. And, you know, let's say it expands up to, you know, its recent high right there, where it's around there. Don't look at the percentage increase. Look at the points, because that's going to be percentage points. That's about a 10% percentage point. We're going to say 10% just to make my example look more convincing. So if we look at the Vega of this call option, which is 0.88, so we'd make $88 if implied volatility goes up by 1%, 1 percentage point. We can go 88 times 10. We'd make $880 if it expands up to the recent high right there, and much more if it expands up further. So we've really put ourselves in a good position to make money if implied volatility increases. Also, if you look at the chart for PayPal, two things. Number one, look at this uptrend. Would you bet against this uptrend? No, I would never bet against this uptrend. If a stock is going up more than it's going down, you should almost never bet to the downside. You may hedge, that's fine, I guess, but you should never really bet to the downside. If 75% of the time something is going up and 25% of the time it's going down, why would you ever bet on it going down? You're putting the odds against you. You want to stack the odds in your favor. So when a stock has this kind of bullish uptrend like this, well, number one, buy it. If it's not, don't buy it if it's a vertical line. Buy it if it has a nice solid uptrend like this, and it's PayPal. We know the company. We know it makes tons of money. You can find out the fundamentals of this company by going to the Analyze tab, looking up PayPal, and you can see the different groups, buy, hold, or sell ratings. I wouldn't put too much weight on these because they are pretty short term. But you can also see the fundamentals of this company. Look at the earnings per share as it grows year to year to year. So we have this long-term uptrend on a great stock that's making loads of money. Perfect. That's one reason to buy. Number two, in the short term, you can see this. There's a lot of momentum to the upside, right? We corrected back down to all these moving averages. All right, we're hitting relative lows here, and it's expanding out of there. We're getting momentum to the upside. That means that it's a continuation of this long-term trend. This is a primary trend, primary long-term trend. This is a secondary downward trend, and this is a resumption of the primary upward trend. And then if we look at the MACD, we have a pretty decent buy signal pretty late. Okay, the MACD is the moving average convergence divergence, which is really hard to see. What that means is we have two moving averages. And what a moving average is it's a line, okay? It's a bunch of points in a row, which is a line. Each point, if we have a 50-day moving average, for example, takes the last 50 days, averages out the closing prices, and puts it on a point. So it gives you an average vibe, a feeling of, what is the trend of the stock over the last 50 days. So what a moving average convergence divergence is, a MACD, is it takes a shorter term moving average. We're going to say 50-day moving average or 50 moving average because it could be 5-minute, 10-minute, 50-minute, 4-hour day, depending on what time chart you're looking at. And for example's sake, and a 100-day moving average, and it lays it across the same chart. If a shorter-term moving average crosses above a longer-term moving average, what that means is the shorter-term trend is contradicting the longer-term trend. We're having a change in trend. And so that can indicate a buy signal. And that's exactly what's indicated on the MACD. Right here, you can see this blue line, which is a shorter-term moving average. It might even be an exponential moving average, I think. Crosses above a longer-term moving average. That is indicated by a bunch of green pillars here and is a buy signal as soon as it crosses over like that. The exact opposite is true if the shorter-term moving average crosses through the longer-term moving average. That's a sell signal. It's a change in the short-term trend that's contradicting the longer-term trend, and it's a sell signal. You can see that happen here where the shorter-term blue moving average crosses below that tan line there, and you can see that as the red bars expand. Of course, we would never take that sell signal too seriously because PayPal's in a strong bullish trend. There's corrections, of course, but I would still always bet to the upside. Okay, the RSI, which is an indication of whether a stock is oversold or overbought, we're above this yellow line to the top, I'm not getting into the math right now, is overbought, and below that is oversold. Okay, it's moving towards overbought, which could be a problem, but here's the deal. People don't just make money off of indicators, okay? You're either a great value investor, you are a god at analyzing fundamentals. You really understand macroeconomics and how political institutions' choices impact the economy as a whole and therefore the stock market, or you're like me, and you don't really give a rat's ass about technical analysis, fundamental analysis, or macroeconomic analysis. And what you care about is buying into long-term trends on companies you understand and like. That's how I make money. These metrics can give you helpful indicators of when to buy to maximize the amount of money you make. But with my strategy, like we discussed, I almost can't lose money, knock on wood, because I'm buying stocks for the long term, and then I'm buying leaps for the long term, capitalizing on a trend I can plainly see, and not trying to capitalize on small microscopic movements or find stocks that have horrible looking charts and terrible fundamentals, but I'm such a good value investor that can understand the potential of the stock, or I don't have to look at the macroeconomics too seriously. I just look at the trend of stocks that are making money that I understand and like, and I buy into the long term, and I also leverage to the long term to the upside with leaps. Okay, so these indicators, like I could make money without them. They're just there to be a little bit helpful in indicating where might be a good time to buy, where it might not be a good time to buy. But at the end of the day, when I'm looking at PayPal, any time's a good time to buy. Of course, I'd rather buy down here than up here, and that's my point. I would not want to buy as soon as something has exploded to the upside, like exponentially, and it's overbought right on the RSI, and then all of a sudden we get a bearish signal on the MACD. That's an indication that maybe things will correct and I can actually get a better deal. But if I had to choose between buying and not buying at all ever, I would buy. So we got momentum going to the upside after coming down, correcting quite a bit, and we're expanding back upwards. That's a good time to buy. That's good enough for me. And I justified buying at the money because implied volatility was super, super low. And I don't want to buy deep in the money because they're so expensive. I can't afford it with my portfolio. Now, that said, this is definitely the riskiest trade out of everything I have open right now, because if I go to the trade tab, you can see the extrinsic value of this option is 23.86. So about $2,300. About half of this option is made up of extrinsic value, while the rest is made up of intrinsic value. That means that by expiration, all this money will be gone. If it gets very deep in the money, that extrinsic value will shrink and be replaced by intrinsic value, which I would prefer. But if it doesn't, and implied volatility, the stock trades sideways and implied volatility does expand, that's good because I'll still make money that way, but I'll probably have to sell the option earlier because that extrinsic value will decay by expiration. If it gets deep in the money, I will probably just not sell, at least not for a long time, not until much closer to expiration. Okay, now that I've caught you up on everything I've been doing, let's go ahead and get started on the wheel strategy. Now, the first thing I do when I want to trade the wheel strategy is I scan for stocks that have good options liquidity and low implied volatility relative to their history, and also have a cheap stock price, okay? Because if I sell a cash secured put, I want it to be for a cheap stock price because if I get a sign, I'm buying 100 shares at the strike. And if the stock's really expensive, I just won't be able to afford it. So if you want to learn how to scan for stocks like that, you can watch the last episode I did. You can find it in the description below. There, I scanned for all these metrics. So I did that through my watch list. Okay, you're going to learn I like sticking to a handful of stocks, okay, between 50 and 100 here. And two came up. Number one was GameStop. Okay, and it's not actually a bad stock to trade cash secured puts on. If we look at implied volatility, it's really high. If you follow this over to the right, you can see that implied volatility is at 2, which basically means there's an implied move of 200% over the next year, which is really, really high, which means options premiums are going to be inflated, and you can find that to be very true. If I go to trade, the trade tab, typically people suggest, from a study that Tastyworks did, to sell cash secured puts and covered calls within 30 to 45 days of expiration. So that's going to be about May 21st, 2021 for me. And they also suggest starting with a 0.3 delta, although I personally think that you can wiggle that around based on how bullish or not so bullish you are on the stock. If you're more bullish, you can sell a cash secured put that's closer to at the money because the stock isn't going to touch it. It's going to go up. If you're less bullish or a little not sure, you can sell it further out of the money for less premium, but you have a lesser chance of being assigned. But if we look at a 0.3 delta, okay, here on the right, follows down to around a 0.3, we could collect about $2,300 in premium just for selling a cash secured put. The problem with this, though, is that the strike is 125. That's one problem. So if we get assigned, we have to pay $12,500 for 100 shares of GameStop. The other problem is, which is a large percentage of my portfolio, about half of it, and which would make it a third if I got assigned because I'm not going to sell any positions to buy these shares. I would use margin or deposit some more cash. So that'd leave a third of my position in GameStop. And then the second problem with that is, of course, GameStop is extremely volatile. It could yank my portfolio around like crazy. So I was like, well, I could sell all the way down at the 40 strike, which is about how much I'd want to, about the strike I'd want to sell a cash secured put at. I wouldn't want to pay more than $4,000 for any one position with my current portfolio being at about $22,000 worth of money. Anything more than $4,000 is going to be a little bit too large of a position for my portfolio, in my opinion. And I could collect not even $100 for that. So, the odds of getting assigned are slim. So I guess that could be nice depending on what you want. But I don't want to get $85 for selling this cash secured put. If we do 85 divided by how much our portfolio is worth, which is $22,500, that's a 0.03% return over the next month. So that's not super great. So the next stock I saw that might be great and always comes up when I want to trade the wheel strategy because it's cheap and implied volatility is generally pretty high, is Snap. If we look at the chart on Snap, let's shrink this back down. Holy shnikes. Okay, we got a long-term bullish uptrend. You might be a little bit not sure what you think about the fundamentals of the company because if you go to analyze, you can see the company's not really making money. It doesn't have any free cash flow. Not looking so hot, but also what's the market cap? The market cap is also really, really tiny. So we don't really care about share price, right? We care about market cap. This is at, well, that's not tiny at all. Honestly, maybe we should run it on Bumble just for the meme. Chart kind of looks like it's bottoming out, right? I'm not saying it's a super bullish chart or anything, but it looks like it's bottoming out on Bumble. What's the market cap of Bumble? No, at least Bumble's had a positive earnings per share. Much smaller market cap than Snap. You know what I think? I think let's do Bumble. Okay, I'm not super familiar with their business. I mean, I've used Bumble before, and I know they have a lot of potential to unload a ton of advertising that they have not done yet, which could be a good way to make money. And I think I'd rather hold Bumble with its tiny market cap. It might be higher risk, but you can see its market cap is what's down here, $6 billion. So that's 6,878 in millions, so it's 6 billion, while Snap is like 98 billion or something like that. So I'd much rather hold Bumble with its smaller market cap with higher risk if I get assigned, but with such a small market cap, it could explode in growth like crazy. And also, if it's exploding in growth, my cash secured puts will be making money. So I think I'm gonna do Bumble just on a hunch here. So let's go ahead and do that. I actually have a pending limit order for Snap. I just don't like the Snap's chart relative to its fundamentals. I'm just not feeling it. I know it's a nice uptrend and all, but for some reason it's not vibing with me. I mean, maybe it's just because I hate Snap. I hate their company. You know, like I understand how they make money, but like I don't. Have you seen the stuff they put on there? It's just so gross. So let's roll with Bumble. Why not? Who cares? Okay, so we're going to May 21st, 2021. We're going to start at about 0.3 delta, which put us at $55 strike. So if it went below $55, we get assigned. So I'm using my price level to double click and create a line. Double click the line, and we go to 55. Okay, so if it dropped down there, we would get assigned over the next month. But I also feel like it is bottoming out. There seems to be a layer of demand right down in here. Like it could easily bust through. Okay, but it just kind of looks like it's bottoming out a little bit. But of course, this is a chart pattern, technically speaking. Okay, that is a chart pattern. I forget what it's called. Okay, falling wedge or something like that, where we have these highs that are constantly getting pressured down, pushed into these constant lows, and eventually this level of demand just breaks as supply and demand reach a breaking point, and there's pressure constantly pushing these highs down. So this is a chart pattern that is actually bearish. Oh, it's hard. Let's just check out the Snap liquidity on their options. Of course, they're really, really good. Okay, when I say really, really good, you can see the bid ask for the one I have a current limit order on is 6 cents wide. But if I go to Bumble, you can see one with a 0.3 delta is like 20 points wide. So, all right. Sorry, I was just thinking there. Let's just roll with the Snap one, okay? So Snap, chart looking a little funky, right? Okay, we have a great upwards trend, right? But we've also had this big expansion, and it could easily be a 3% or more contraction after this. It's not oversold on the RSI or anything, but you know, if I've learned anything in my life, it's buy low, sell high. So what I did was I entered a limit order for a cash secured put. Okay, I did it right at a 0.3 delta, or as close as I could get. So delta here is 0.26, and we can sell that for about $250, which is great because $250 is a much better return than the return we were looking at for GameStop with a 40 strike, which was 0.03% return. Here, if we get $250 divided by how much money we have, $22,571, that'll be about a 1% in a return in a month, which is great. You know, the wheel strategy isn't for making tons of money. It's for making extra money. And this is, I mean, if you put this out to a year, 1% return each month for a year, that's a considerable return. You probably would beat the average S&P 500 if you could do this consistently for the entire year. So it's to make some extra money, which is some good extra money, consistently. It's like dividends, but not as stupid as dividends. Instead of a company taking their money and giving it to you instead of reinvesting it in themselves to accelerate the growth of the stock, you are creating your own dividends without affecting the stock price in any way. So it adds consistency to your portfolio. It takes advantage of your margin because we're going to be running this on margin, right? We have almost no buying power left, $40. So we're running this on margin. If we get assigned, we'll buy the shares on margin, but we have none of our actual money held aside for collateral. So we're not using any of our actual money, but we're creating this consistent income that can be reinvested into our stocks or leaps or other trades. And you can see I can open it for about $251 to $254. Okay, if I wanted to open it immediately, I had to sell at $251 at the bid price. Bid price right there. But if we go to my monitor tab, let's take a look at what I set it for. We have a working order. I put it for a $3 limit. Okay, that puts us pretty darn low. This line on the chart represents roughly where the stock will have to go in order for this option to get filled. So I sold a cash secured put by going to this options chain, selecting the bid price on the put I wanted to sell. We can see these are puts because puts are right up there. I select that. Okay, I turn the quantity to 1, and instead of selling it right where it is, I want to anticipate a possible correction in Snap and get a better price. As Snap goes down, puts will increase in value, which means I can sell puts for more money. So I changed this limit order to 3, so I'll get $300. We can see the estimated expected price Snap will have to be at in order for this put to get filled, which is around 60.12. Okay, so it's down here where this red line is, where our limit order is. And then instead of leaving this at day, which means that if this doesn't get a fill, it'll cancel by the end of the trading day, I put this to good till canceled. Okay, and then I hit confirm and send. And that's exactly how I have this limit order open right now. Okay, so we're gonna leave it there, and that means it might take a day or two, or maybe even longer to get a fill. And if things start continuing up, keep going up, and I feel like my order's not gonna get a fill, I'll reevaluate. It's no big deal because I can always sell it for roughly the same premium because I'll shift it to a 0.3 delta again. If this stock price goes up, the delta of this option is going to change to a much lower delta as it gets further out of the money, and so is the premium I could sell it for. Well, I'll just sell a higher strike put then at that point. For now, I want to try to squeeze out as much money as I can from this put option, so I set a limit order for a higher price than it is being currently traded. And now we wait. Okay, that's all I'm going to do for today. So I've caught you up on everything: the PayPal call, my new stock positions, and the money I added to Microsoft and Apple. And then we also are getting started on the wheel strategy, but we're trying to get a deal on this put. Okay, we don't want to just sell it for nothing. We're not losers here. All right, we want to haggle. We want to make them pay. So we're going to make them pay us $300. I'm getting $300 no matter what, baby. Okay, I'm sorry, I'm back. I changed my mind about Snap. It just doesn't feel right. It just doesn't feel right. I kind of want to do Bumble. It seems like a more interesting opportunity, especially with a company with such a small market cap. And to be honest, right, the idea behind this this kind of pattern is that there's supply that is constantly pushing these highs down into a level of demand. And down here, buyers have placed stop losses somewhere in this region, somewhere below this level of support where there's demand. Supply is also ultimately going to overwhelm demand, pushing through this level of support, and then triggering a bunch of stop losses. That should, in theory, continually push the stock price down as stop loss orders get filled, all these sell orders get filled, the supply continues to overwhelm demand, and there could be a drop off a cliff. Frankly, two things kind of make me think that's not going to happen. Number one, I think with Bumble's tiny market cap and its potential to integrate a ton of advertisements to increase its revenue, I think people will see Bumble as a good opportunity. That's how I think from a fundamental perspective, which should play in the stock price, number one. Number two, this kind of looks fake. I don't know why. It just doesn't look right to me. I've seen it happen before, especially on low float stocks where you have those highs getting pushed into a level of support. It tends to happen over a lot of time, and then suddenly it'll break down in one huge move. I've seen that happen before. This doesn't give me the same vibe. Okay, I could be wrong. It just seems like more of an interesting opportunity, and what I'm looking at right now isn't screaming a lot of anything at me. Looks more just like consolidation. So let's go ahead and open a cash secured put on Bumble. And I'm, when it's this low in the pattern where the next thing is either it breaks down or it breaks up, well, since I'm going bullish on it, I'm assuming it's gonna break up. Okay, just kind of a hunch. It's gonna break up, so that means that it's already low within this pattern. The next thing that's probably gonna happen is either it's gonna consolidate or break upwards, which means I want to get into this put relatively quickly. So I'm probably just gonna enter it at the mid price. So we have our 0.3 delta for this put option. It's a 55 strike. If we get assigned, we'll pay $5,500 for those shares. We have $6,000 available, and I'll probably deposit more, so that leaves plenty to buy those shares at the strike price. So we are going to open it there. I don't want to open it further out of the money. I don't want to open it in the money for sure. So let's open it with the 0.3 delta at the mid price. So here we are. We have the option open. So all I did was click on the bid price. Opens up, change the quantity to 1. And I bet you can change the default. Actually, you can change the default quantity and set up application settings, order defaults, options, default quantity 1. Apply. There we go. Now that will always be 1. So we're going to put it at the mid price. That's exactly where I'm going to put it. I bet we get a fill immediately, and we're going to roll with that. Okay. I can't give like a super great explanation. That's just what I think. Seems like a better opportunity. Just give me the right vibes. Okay, and with the wheel strategy, I'm not too concerned of whether or not this goes tits up. It's not going to be a huge deal. Seems more interesting. All right, let's send it off. Confirm and send. Remember, we can hit shift clicked, because if we hit confirm and send, we have auto send with shift click, so we can go shift click or not, whatever. Hit send. Okay, now it's pending. We'll wait a few seconds. All right, we're going to set it for 265. The deal is, like, if it's going to go down, it's going to go down big. Okay, and I'll just be wrong, and I'll probably be rolling like crazy to avoid assignment. If it doesn't go down, it's if it's not gonna be super bearish, if it's not gonna break this level of support, then there's not much further it's going to go down at all. So I'd rather just get in, because either way, I'll be eating my words here in a minute if it breaks through this level of support. So let's go ahead and cancel and replace this order. We'll set it for the new mid price of 265. There we go. Got a fill. All right, we'll see how my hunch plays out. Okay, so we have long-term and leap, so we don't have the wheel. So let's move to group. We can add group, and we'll call it the wheel. Hit OK. There we go. It's in the wheel. Already down $2.50 based on the mid price, and we'll call it a day. Okay, we'll see if I ate my words or not, but for some reason that just makes me feel better. Okay, so welcome to my mind, right? When you see trades just appear on your screen on Iris, it looks like I just want to do this, and I click send. In reality, I'm constantly second guessing myself and thinking about things, and also just getting and analyzing my confidence level. You know, I'm assuming I have a certain level of intuition after doing this a lot of time. Doesn't mean I'm correct, but I can't go against my gut, so I'm gonna go with Bumble on this one. All right, that's all, folks. I'll catch you later when something interesting happens. Follow me on Iris, of course, down below. There's free stocks down there, and pins by Charlie. Check those out. They're pretty dope. Love you. I'll catch you later.